What if everything you've been told about index funds is only half the truth? Most people invest in index funds believing they are making the safest, smartest, financial move possible, but there are critical facts the financial industry rarely mentions. Facts that could quietly drain your wealth over decades. Stay with us until the end, because this information could completely change how you invest. And if you're new here, please subscribe. We bring you honest, research-backed financial content every week. Index investing was born in 1975, when Vanguard's founder Jack Bogle proposed the radical idea that simply buying and holding the entire broad stock market would outperform most actively managed strategies. His creation, the Vanguard 500, was mocked by skeptics and widely dismissed as a recipe for mediocre, subpar results. Time, however, proved the critics wrong. Index funds became one of the most powerful wealth-building tools in modern history. Over a 20-year period, fewer than 1 out of 10 actively managed mutual funds actually beats the market. This holds true across every category: US stocks, international stocks, small stocks, growth stocks, value stocks, real estate investment trusts, and every type of bond. Perhaps most strikingly, over the last 20 years, 2/3 of all actively managed mutual funds performed so poorly they were closed or merged into another fund entirely. These are extraordinary numbers. On the surface, index funds appear unstoppable, but the story doesn't end there. Index funds can be one of the best ways to invest over time because they provide diversification at low costs. But they do come with significant drawbacks that many investors simply overlook. The first thing nobody tells you is about concentration risks, something hiding inside your diversified fund right now. Because the S&P 500 and many other stock market indexes are market cap weighted, the largest companies make up the largest weights in both the index and the funds that track them. The so-called Magnificent Seven tech stocks make up approximately 34% of the entire S&P 500, as of mid-2025, up dramatically from just 20% back in 2023. Investors in S&P 500 index funds who are looking for broad diversification are, in reality, making a concentrated bet on just 7 companies. Think about that. You believe you own a slice of the entire American economy, but more than 1/3 of your money rides on 7 technology giants. Because of the way traditional indexes are structured, the bigger the company, the bigger its weight, leaving investors far more vulnerable to bubbles, which inevitably burst. At the height of the 1999 internet craze, technology stocks made up nearly 30% of the S&P 500. By 2002, that allocation had collapsed to just 14%, wiping out enormous amounts of investor wealth. History is very clear about what happens when one sector becomes dangerously overweighted in an index. Index funds also suffer from a number of mechanical issues that can lead to unintended consequences for ordinary investors. The second hidden truth involves how index funds actually buy and sell stocks, and it's not as passive or harmless as you think. Since index changes are almost always publicly announced several trading days ahead of the actual rebalancing, traders benefit by buying new members and selling the exiles, while index funds are forced to wait until the changes are officially made. This means index funds consistently buy at higher prices and sell at lower prices during rebalancing, the exact opposite of smart investing. Even the S&P 500, which is not formally rebalanced, undergoes 20 to 25 changes in an average year as companies are added to and removed from the index. Every single one of those changes costs money, and those costs quietly reduce your returns year after year. The third hidden truth is about tracking error, the gap between what your fund promises and what it actually delivers. While index funds strive to closely match their benchmark indices, Various factors, including fees and cash flow timing, can lead them slightly off course from achieving perfect alignment with their target indexes. If there is high volatility in the market when new investments flow into an index fund, those transactions could result in purchases that don't fully reflect current valuations over many years. Small tracking errors compound into meaningful differences in your actual portfolio balance. The composition of index funds has also changed dramatically over the past 25 years, and not necessarily for the better. A typical index fund from the late 1990s tracked a broad index holding hundreds of stocks weighted by market capitalization. Today's index funds, on average, have far fewer holdings and employ a much wider range of approaches to weight their investments. Many modern index funds look and perform meaningfully differently from their category benchmarks, being passive in name but genuinely active in the risks they take and the rewards they seek. This is a critical distinction that millions of investors never realize when they hand over their savings. The fourth hidden truth is about fees, and while they've fallen dramatically, they still matter enormously over time. Average fees on stock mutual funds have declined from 0.99% in 2000 to 0.40% in 2024 on an asset-weighted basis, which is a remarkable improvement for ordinary investors. However, the unweighted average expense ratio in 2024 was a much higher 1.10%, meaning if you randomly selected a mutual fund, that's closer to what you'd actually pay. Some index funds tracking identical portfolios can range from 0.25% to as much as 1.5% in fees, and that is real money compounding against you over decades. The difference between a 0.05% fee and a 1% fee on a $100,000 portfolio over 30 years can amount to tens of thousands of dollars in lost wealth. Vanguard's average index fund expense ratio stands at just 0.04%, while the broader industry average sits at 0.17%. A significant gap that highlights how important provider selection truly is. The fifth hidden truth is one that shocks most investors. Index funds can quietly damage your governance rights as a shareholder. Because index funds are required to passively invest in every stock in the index, there is little incentive for fund managers to be actively involved in individual company governance issues. Index funds use their significant proxy voting powers to approve executive pay packages, 19% more often than active funds do, often voting along with management without scrutiny. This means that as passive investing grows, corporate executives face less accountability and shareholder power slowly erodes for everyone. The widespread adoption of index funds masks hidden risks, including the concentration of corporate influence among a small number of large asset managers and systemic dangers posed by passive investing at scale. The sixth hidden truth involves what happens during a market crash, and it is not what most investors expect. Index funds are designed to mirror specific market indices like the S&P 500, which means they automatically rise and fall with those markets with no room for maneuvering when conditions change dramatically. This happened dramatically in both the flash crash of 2010 and on August 24, 2015, when the S&P 500 dropped 5.3% within minutes of the opening bell, and ETFs from every major fund family lost between 20 and 50% temporarily. In a deeply volatile market, passive index investing offers no defense mechanism whatsoever. There is technically no such thing as a truly passive mutual fund or ETF, because a decision is still being made, the decision to follow a specific index over all others. What matters most for investors is whether the guiding framework focuses on increasing returns with appropriate risk, or simply on rigidly satisfying constraints to follow a particular index. The seventh and perhaps most overlooked truth is about the so-called zombie ETF problem, funds that quietly fail their investors. For lesser-known indexes, there is a significant risk of the ETF provider discontinuing the fund, in which case investors can be liquidated without their consent, or left holding an illiquid zombie ETF nobody else wants to buy. Approximately 200 funds tracking stock and bond indexes existed in 1998, with that number rising to more than 2,000 by the end of 2022, and most of the new indexes had almost no live track record when funds began tracking them. Most new indexes had as little as 4 months from launch to becoming the target of a fund, with roughly 1/6 of indexes having fewer than 30 days of live performance history before investors put their money in. Investors placing money into new index funds must often rely entirely on back-tested data rather than real-world, live performance results. Back-tested index performance often looks impressive, but it typically fails to live up to those expectations once the fund begins operating in real market conditions. Despite all of this, the data still shows that index funds remain among the most reliable investment vehicles for the long-term patient investor. Index funds are generally less risky than holding shares in just one stock, offering broad diversification across many industries and companies despite concentration concerns at the top. A blending of traditional passive index funds with a touch of active management may actually hit the sweet spot of optimal return with appropriate risk for most investors in today's market environment. Investors who wish to limit their exposure to the Magnificent Seven can buy equal-weighted index funds or value-based funds that reduce or eliminate premium-priced megacap stocks. The truth about index funds is neither the fairy tale the industry sells, nor the nightmare some critics describe. It lives somewhere in between. Index funds work, but only for investors who understand exactly what they own, what they're paying, and what risks they are silently accepting. Blindly following the crowd because everyone invests in index funds is not a financial strategy. It is hope, dressed up as a plan. The informed investor generally concludes that index funds are the worst way to invest, except for almost all of the other options currently available. That nuance is exactly what separates wealthy investors from those who simply break even over a lifetime. Know your fund's fee. Understand its concentration. Check its tracking error. Question who is voting your shares. These are not complicated steps. They take an afternoon of research, but they could protect years of your financial future. Now we want to hear from you. Do you currently invest in index funds? Have you ever looked closely at what's inside them? Do you feel more confident now about the risks? Or does this change how you think about your portfolio? Drop your thoughts in the comments. We read every single one and would love to start this conversation with you. And if this video gave you something valuable to think about, please consider subscribing to our channel. We publish honest, thoroughly researched financial content designed to help ordinary people make smarter money decisions. Hit the subscribe button, turn on the notification bell, and join a community that takes financial education seriously. Your future self will thank you for it.